Have you ever wondered why some investors lose thousands while others grow their wealth steadily? Most people think investing is about luck, but mistakes silently eat away your money. Today, we will uncover 5 common investment mistakes and show how to avoid them. Small errors can cost you thousands over time if ignored. This video will give you actionable strategies to protect your money. Every choice you make in investing affects your financial future. Like, subscribe, and comment if you want to stop losing money to hidden errors. Let's dive into the 5 investment mistakes that could be silently draining your wealth. Number 10. Ignoring the power of diversification. One of the biggest mistakes investors make is putting all their money in one place. Concentrating investments in a single stock, sector, or asset class is risky because one market downturn can wipe out years of growth. Diversification spreads risk across multiple assets, reducing exposure to sudden losses. Balancing between stocks, bonds, property, and alternative investments can protect wealth. International diversification further shields against country-specific economic shocks. Ignoring this principle often leads to missed opportunities and increased risk. Smart allocation ensures your portfolio can withstand volatility. Understanding diversification is essential for long-term growth and financial stability. Number 9. Trying to time the market. Another costly mistake is attempting to buy low and sell high perfectly. Markets are unpredictable, and even experienced investors often fail to time their entries and exits correctly. Chasing trends or reacting emotionally to short-term news can result in buying high and selling low. Instead, consistent investing with a long-term perspective often outperforms attempts to time market swings. Dollar-cost averaging reduces the impact of volatility while keeping you invested. Relying on luck rather than strategy increases stress and financial risk. Patience is far more profitable than chasing quick wins. Focusing on disciplined, long-term strategies protects your investments from costly mistakes. Number 8. Ignoring fees and hidden costs. Many investors overlook the fees charged by brokers, funds, and advisors, which slowly eat away returns over time. High management fees, transaction costs, and unnecessary expenses can cost thousands over decades. Even small percentages matter when compounded over years. Low-cost investment options can deliver the same growth with less money lost to fees. Reviewing account statements regularly ensures transparency and control over expenses. Hidden fees reduce the effectiveness of your financial plan silently. Being aware of costs allows better allocation and higher net returns. Understanding every fee you pay is critical for long-term investing success. Number 7. Letting emotions drive decisions. Emotions like fear and greed often dictate poor investment decisions. Panic selling during a market drop locks in losses, while overconfidence during a bull run leads to risky bets. Following news headlines blindly can trigger impulsive moves that harm your portfolio. Creating a clear investment plan and sticking to it prevents emotional mistakes. Automation through regular contributions reduces emotional interference. Disciplined strategies help maintain balance and long-term growth. Ignoring emotions often results in buying high and selling low repeatedly. Mastering your psychology is just as important as mastering the market itself. Number 6. Neglecting proper research. Investing without adequate research is like driving blind in a storm. Failing to understand a company, asset, or market trend increases the likelihood of losses. Relying on rumors, social media tips, or hearsay often misleads investors into risky choices. Proper due diligence involves reviewing financial statements, understanding risks, and studying market trends. Analyzing historical performance and future potential reduces costly mistakes. Neglecting research leads to poor timing, overpaying, or investing in unstable assets. Knowledge empowers investors to make informed decisions confidently. Research is the foundation for sustainable, profitable investing over the long term. Number 5. Ignoring risk management. Many investors focus on returns but ignore the importance of risk management. Not setting stop-loss limits or failing to diversify exposes portfolios to catastrophic losses. Over-leveraging amplifies gains but also increases potential for financial disaster. Hedging strategies, insurance, and protective investments can minimize damage during market downturns. Regularly reviewing and adjusting risk exposure is essential for safety. Ignoring risk is a slow drain on wealth that often goes unnoticed. Disciplined risk control ensures stability during turbulent periods. Prioritizing risk management safeguards your long-term financial goals. Number 4. Chasing past performance. Another common trap is investing solely based on historical returns. Just because an asset performed well in the past does not guarantee future results. Blindly following trends or hot stocks can lead to losses. Analyzing fundamentals and growth potential is far more reliable than chasing history. Investors should consider market conditions, sector health, and economic indicators before committing. Relying on past performance can create overconfidence and reckless decisions. Avoiding this mistake helps maintain a disciplined approach. Focusing on informed projections preserves wealth over speculation. Number 3. Underestimating the impact of inflation. Investors often ignore how inflation reduces the real value of returns over time. A portfolio growing at 5% per year may lose value in real terms if inflation is higher. Factoring in inflation ensures that your wealth actually grows in purchasing power. Ignoring it can turn seemingly profitable investments into net losses. Strategies like investing in index-linked bonds, real estate, or growth stocks help preserve value. Monitoring inflation trends and adjusting allocation is crucial for long-term security. Understanding this mistake allows smarter planning. Protecting against inflation prevents silent erosion of financial gains. Number 2. Lack of a long-term plan. Many investors jump into the market without a clear strategy or timeline. Without goals, risk tolerance assessment, and exit plans, it's easy to make impulsive decisions. Long-term planning includes setting realistic targets, understanding cash flow needs, and balancing growth with stability. Ignoring this creates scattered investments and poor outcomes. A structured plan guides decision-making and reduces costly mistakes. Adjusting your plan as life and markets change ensures alignment with goals. Patience and discipline drive consistent results. Long-term planning turns short-term volatility into wealth-building opportunities. Number 1. Failing to review and adapt. Even experienced investors make the mistake of neglecting portfolio reviews. Markets evolve, companies change, and personal circumstances shift, yet many fail to adjust their strategy. Regular reviews allow you to rebalance, cut underperforming assets, and seize new opportunities. Ignoring changes can result in outdated allocations and unnecessary losses. Adapting to market trends and life events keeps your investments optimized. Reviewing quarterly or annually ensures that risk and growth align with goals. Failing to adapt is a silent drain on wealth. Proactive evaluation is essential for consistent long-term success. Avoiding these 5 common mistakes is the fastest way to stop losing thousands in investments. Proper research, disciplined strategy, risk management, diversification, and regular reviews can protect your wealth. Every decision you make today shapes your financial future. Start applying these lessons immediately to see real results. Don't forget to like, subscribe, and comment to share your experiences and stay on top of your investing game.